Imagine you're driving a modern electric car. The dashboard responds instantly. The navigation predicts traffic. The battery manages itself. Hundreds of software systems work together so seamlessly that you hardly notice the engineering behind them. But who actually built all this? Most people would say the car manufacturer. The truth is, many of these technologies are designed by specialized engineering companies working behind the scenes. One of them is Tata Technologies. Unlike Tata Motors, which manufactures vehicles, Tata Technologies helps companies design, engineer, test, and digitally transform the products they build. Think of it as the architect behind the building, rarely seen, but essential to its creation. Today, the company partners with global leaders in automobiles, aerospace, industrial machinery, and heavy engineering, helping them bring smarter products to market faster. It is also embedding AI across the engineering lifecycle as manufacturing moves towards software-defined products. This places Tata Technologies at the intersection of some of the world's biggest trends: electric vehicles, smart factories, artificial intelligence, digital engineering. But a promising industry doesn't automatically make a great investment. A famous brand doesn't guarantee future returns. And a rising stock price doesn't always reflect a stronger business. So instead of chasing headlines, let's answer the questions that truly matter. What exactly does Tata Technologies do? How does it make money? What makes it different from its competitors? Is the business becoming stronger? And more importantly, is the stock worth owning? Because in the long run, successful investing isn't about predicting tomorrow's price. It's about understanding today's business. And that's exactly where our journey begins. Before judging Tata Technologies, we must first understand the industry it operates in. Because even the best company struggles in a declining industry, while a growing industry can lift even average businesses. Fortunately, Tata Technologies operates at the center of one of the biggest industrial transformations of our time. Manufacturing is being reinvented. Manufacturing today is very different from what it was 20 years ago. A modern car is no longer just an engine with four wheels. It is packed with software, sensors, electronics, AI, cloud connectivity, and millions of lines of code. Aircraft have become flying computers. Factories are becoming smart, using robots, digital twins, automation, and artificial intelligence to improve productivity. As products become more complex, manufacturers increasingly rely on specialist engineering partners instead of building everything in-house. That is exactly where Tata Technologies fits in. It doesn't manufacture cars or aircraft. It helps companies design them faster, smarter, and more efficiently. The four growth drivers. Several powerful trends are creating long-term demand for engineering companies. First is the global shift to electric vehicles, which requires completely new battery systems, electronics, and software. Second is the rise of software-defined vehicles, where software has become as important as the engine itself. Third is digital manufacturing, with companies adopting AI, automation, digital simulations, and smart factories to reduce costs and improve quality. Finally, manufacturers are increasingly outsourcing engineering work to specialist firms, allowing them to access expertise while keeping costs flexible. Together, these trends create a long runway for engineering service providers like Tata Technologies. But it's not an easy business. The industry also has its challenges. Engineering spending slows during economic downturns as companies postpone new projects. Technology evolves rapidly, forcing firms to continuously invest in new capabilities. Competition is intense, with global engineering firms and IT companies chasing the same clients. And since engineering companies sell expertise rather than products, attracting and retaining talented engineers remains one of their biggest challenges. The big picture. So, the industry offers enormous long-term opportunities, driven by electric mobility, digital engineering, smart factories, and outsourcing. But success isn't guaranteed. The ocean is growing, but every ship still has to navigate it well. Which brings us to the next question. If the industry itself is so attractive, what makes Tata Technologies different from everyone else? Let's understand its business model next. So far, we've learned that Tata Technologies operates in an industry with powerful long-term tailwinds like EVs, AI, and digital manufacturing. But a growing industry alone doesn't guarantee success. The real question is, how does Tata Technologies actually make money? And why do customers keep choosing it? Helping build cars without building cars. Tata Technologies doesn't manufacture vehicles. It helps manufacturers design, engineer, test, and validate them. Imagine developing a new electric car. Before a single vehicle rolls off the assembly line, engineers must decide battery placement, vehicle weight, cooling systems, software integration, safety standards, and thousands of other details. This is where Tata Technologies comes in. Think of it like building a hospital. The construction company builds it, but architects and engineers create the blueprint first. Tata Technologies provides that engineering expertise for manufacturers. This engineering services business generates about 77% of the company's revenue, making it the core of the business. The digital manufacturing business. Modern manufacturers don't just build products, they manage enormous amounts of engineering data. Thousands of engineers, suppliers, and designers often work together across multiple countries. Without a common digital platform, projects quickly become unmanageable. That's where Tata Technologies' second business, Technology Solutions, comes in. The company helps customers manage product design, engineering data, manufacturing processes, and product lifecycle management through digital platforms. Although it contributes around 23% of revenue, this segment has been growing faster than engineering services and represents an important future growth opportunity. Why customers stay? Engineering partnerships aren't easy to replace. Imagine changing your chartered accountant after 10 years. A new accountant would need months to understand your business. The same applies here. Once Tata Technologies understand a customer's products, systems, and engineering processes, switching to another partner becomes costly and time-consuming. These long-term relationships create an important competitive advantage built on expertise and trust, not simply price. The company's greatest asset. Unlike automobile manufacturers, Tata Technologies doesn't own massive factories. Its most valuable asset is its people. Thousands of engineers, designers, and software specialists form the company's intellectual capital. This makes hiring and retaining talent one of management's biggest priorities because experienced engineers carry valuable knowledge that's difficult to replace. Looking beyond automobiles. While automotive remains its largest business, Tata Technologies has expanded into aerospace, industrial machinery, and digital manufacturing. This diversification reduces dependence on a single industry while opening new avenues for growth. At the same time, the company continues investing in AI, smart manufacturing, and software-defined vehicles, ensuring it evolves alongside its customers. Key takeaway: Tata Technologies generates revenue through two complementary businesses. Engineering services, helping customers develop better products. Technology solutions, helping them digitally manage the entire product lifecycle. Together, these businesses create long-term customer relationships based on deep technical expertise and execution. But a strong business model is only part of the story. The next question is even more important. Is this business generating healthy profits, strong cash flows, and shareholder value? That's what we'll explore in the next chapter. So far, we've seen that Tata Technologies operates in a promising industry with a strong business model. But every great business must answer one question. Do the numbers support the story? Because no matter how exciting the future sounds, a company must consistently generate revenue, profits, and cash to create long-term value. Revenue. Is the business growing? Revenue is simply the total value of products or services a company sells. Think of it like a grocery store. If customers buy goods worth 10 lakh rupees, the store's revenue is 10 lakh rupees, regardless of whether it made a profit. For Tata Technologies, the long-term trend is positive. Revenue has grown at around 18% annually over the last 5 years. However, growth has slowed to roughly 8% over the past 3 years. The business is still expanding, just at a more measured pace. Profitability, how much does it keep? Sales alone don't make a business successful. What matters is how much profit remains after paying operating costs. This is measured by the operating profit margin, OPM. Tata Technologies currently earns an operating margin of about 15.5%, meaning it keeps roughly 15 rupees for every 100 rupees of revenue after operating expenses. That's healthy, although lower than a few years ago, indicating some pressure on margins. The encouraging sign is that recent quarters show early improvement. Efficiency. Is management using capital well? Two important measures answer this question: return on equity, ROE, and return on capital employed, ROEs. ROE shows how efficiently management uses shareholders' money, while ROEs measures returns generated from all capital invested in the business. With a ROE of around 16% and a ROEs of about 21%, Tata Technologies continues to deliver solid returns, reflecting an efficient business despite slower growth. Cash flow. Are profits turning into cash? Profit on paper isn't always cash in the bank. A company may record sales today but receive payment months later. That's why investors watch operating cash flow. Over the last 3 years, Tata Technologies has generated more than 1,700 crore rupees in operating cash flow, closely matching its reported profits. That's a reassuring sign that earnings are backed by real cash generation. Debt, is it a risk? Debt isn't necessarily bad, provided it's manageable. Tata Technologies has a debt-to-equity ratio of around 0.24, and its earnings cover interest costs more than 26 times. In simple terms, the company carries debt comfortably without putting financial stability at risk. Overall financial health. The financial picture is balanced. The company continues to grow, generates healthy profits, produces strong cash flows, earns attractive returns on capital, and maintains a conservative balance sheet. The main concern is that revenue growth has slowed and profit margins haven't fully returned to earlier levels. So while the foundation remains strong, investors now want to know one thing: is the business beginning a new phase of growth, or is it still waiting for momentum to return? That's exactly what we'll explore in the next chapter, where we break down Tata Technologies' latest financial results and what they reveal about the company's future. So far, we've seen that Tata Technologies has a solid financial foundation. But strong historical numbers alone don't make a great investment. The bigger question is the business moving in the right direction today? The recent performance suggests that it is. Revenue growth has picked up, driven by increasing demand for engineering and digital transformation services. More importantly, this growth is coming from both of the company's major businesses, engineering services and technology solutions, making the business more balanced. Engineering services continues to win large, multi-year contracts from global manufacturers. These long-term projects provide better revenue visibility and reduce uncertainty about future business. At the same time, technology solutions is becoming an increasingly important growth driver. As manufacturers invest in automation, artificial intelligence, and digital product development, demand for these solutions continues to rise, creating new opportunities for the company. Profitability is also showing signs of improvement. Operating margins have started recovering as costs become better controlled. While there's still room for improvement, the overall trend is encouraging. One of the biggest strengths remains cash generation. The company continues to convert its business into healthy operating cash flow, giving it the flexibility to invest in future growth without relying heavily on debt. Another positive sign is the quality of its customer base. The company is expanding relationships with large global clients, which often leads to repeat business and more predictable revenues over time. Overall, the picture is that of a company rebuilding momentum rather than one already operating at full speed. Growth is improving, cash flows remain healthy, and management appears optimistic about the opportunities ahead. But numbers alone don't determine a company's future. Behind every successful business is a leadership team making strategic decisions that shape long-term growth. So before deciding whether Tata Technologies deserves a place in your portfolio, there's one final question to answer. So far, we've looked at Tata Technologies' financial performance and growth outlook. But numbers alone don't build great companies. People do. A business is like a ship. Even with the best technology, it still needs a capable captain to navigate changing conditions. That's why evaluating management is just as important as studying financial statements. One encouraging sign is that Tata Technologies is investing in the future, not chasing short-term profits. Its focus remains on artificial intelligence, software-defined vehicles, digital engineering, smart manufacturing, and product lifecycle management. These aren't random ventures, they build on the company's existing strengths, reducing risk while expanding opportunities. Another positive is the quality of customers the company is winning. Instead of simply adding more projects, Tata Technologies is securing larger global clients. Major manufacturers don't award critical engineering work based on price alone. They look for technical expertise, execution capability, and long-term reliability. Winning repeat business from such customers is a strong vote of confidence. Management has also maintained financial discipline. The company generates healthy cash flow, keeps debt under control, continues paying dividends, and still invests for future growth. It's like a family that saves and invests even after receiving a salary increase rather than spending everything immediately. That balance often creates stronger long-term wealth. Institutional investors seem to share this confidence. Foreign institutional investors and domestic institutional investors have gradually increased their holdings, while public shareholding has declined. This doesn't guarantee future returns, but professional investors usually spend months studying companies before investing. Their growing participation suggests increasing confidence in Tata Technologies' long-term prospects. Promoter confidence adds another layer of comfort. The Tata Group continues to hold around 55% of the company, and importantly, none of these shares are pledged. A high, unpledged promoter stake generally reflects financial stability and alignment with minority shareholders. Of course, there are still challenges. One strong quarter doesn't prove that higher margins will continue. Management must sustain revenue growth, retain skilled engineering talent, and stay ahead as artificial intelligence reshapes the engineering services industry. Overall, Tata Technologies appears to have a management team focused on long-term value creation rather than short-term market excitement. They're investing in future technologies, attracting larger customers, maintaining financial discipline, and earning growing institutional trust. But there's one final question every investor must ask. Even if this is an excellent business, is the stock already priced for perfection? That's what we'll answer in the final chapter, where we evaluate Tata Technologies' valuation and decide whether the stock deserves a place in a long-term investment portfolio. So far, we've understood the business, explored the industry, analyzed the financials, studied the management, and seen why Tata Technologies stands out. But every investment faces one final test. Even the best company can become a poor investment if the price is too high. Imagine finding your dream house. Perfect location, excellent construction, everything you want. But the owner asks twice the market price. The house hasn't changed. Only the price has. The same principle applies to stocks. A great company isn't automatically a great investment at every valuation. Why is the market paying a premium? One of the simplest ways to judge valuation is the P/E ratio. Think of buying a business that earns 1 crore rupees a year. If someone asks 10 crore rupees, you're paying 10 years worth of earnings. If buyers are willing to pay 49 crore rupees, They're not buying today's profits, they're betting on much bigger profits tomorrow. That's exactly what's happening with Tata Technologies. Its PE of around 49 reflects high expectations for future growth rather than current earnings. Why are investors optimistic? The reasons are clear. The company operates in fast-growing industries like EVs and digital engineering, enjoys long-term customer relationships, has a debt-free balance sheet, strong cash generation, and continues investing in future technologies. Simply put, the market believes tomorrow's Tata Technologies will be much larger than today's. The challenge of a premium valuation. A premium valuation comes with pressure. Think of two students. One usually scores 70%, the other 95%. If the first scores 75%, everyone is happy. If the second scores 88%, people ask what went wrong. The stock market behaves the same way. Because expectations are already high, Tata Technologies doesn't just need good results, it needs results that exceed expectations. Even small disappointments can trigger sharp corrections. Looking beyond the numbers, the company also trades well above its book value. But that's common for knowledge-driven businesses. Its real assets are its engineers, intellectual property, customer relationships, and decades of engineering expertise, things that don't fully appear on a balance sheet. Similarly, metrics like the PEG ratio can be misleading during periods of temporary earnings slowdown. No single ratio can capture the complete investment story. The real question, the key question isn't, is Tata Technologies expensive? It's, can it grow fast enough to justify today's price? If growth, margins, and digital engineering demand continue to improve, today's valuation could prove reasonable. If not, the market may reassess the premium it's willing to pay. Because valuation isn't just about numbers. It's about expectations. What's next? We've now understood the business, industry, financials, management, and valuation. Only one piece remains. What could go wrong? Because successful investors don't ignore risks. They understand them before they invest. So far, Tata Technologies has looked like a business with many qualities investors admire: a growing industry, strong engineering expertise, healthy finances, and long-term opportunities. But every investment has another side. The biggest mistakes in investing usually don't happen because people fail to find good companies. They happen because people stop asking one simple question. What could go wrong? Think about buying your dream house. Everything looks beautiful from the outside. But before signing the papers, you'd still check for hidden cracks, leaking pipes, or legal issues. Not because you expect problems, but because knowing the risks helps you make a better decision. Investing is no different. For Tata Technologies, the first challenge is that its future is still closely linked to the global automotive industry. Although the company is expanding into aerospace, industrial machinery, and digital manufacturing, automobiles remain its biggest business. If carmakers delay launching new vehicles or cut engineering budgets during an economic slowdown, Tata Technologies could also feel the impact. The second challenge comes from success itself. The market already expects Tata Technologies to deliver exceptional growth. And when expectations become high, even good performance may not be enough. A single disappointing quarter can hurt the stock far more than it would for an average company. Premium businesses must consistently prove that they deserve their premium valuation. Competition is also becoming tougher. Engineering services have become one of the fastest growing areas in technology, attracting global specialists, consulting firms, and large IT companies. Just like a successful restaurant eventually attracts new competitors, Tata Technologies must continue innovating if it wants to stay ahead. And innovation depends on people. Unlike a manufacturing company that relies mainly on machines, Tata Technologies depends on thousands of highly skilled engineers. As demand for experts in artificial intelligence, electric vehicles, and digital engineering continues to rise, attracting and retaining talent will remain one of the company's biggest challenges. Technology itself adds another layer of uncertainty. The tools that seem cutting edge today may become outdated within a few years. That means the company must continuously invest in new skills, research, software platforms, and innovation. In technology, standing still is the fastest way to fall behind. Finally, because Tata Technologies serves customers across the world, it is naturally influenced by the global economy. During uncertain times, manufacturers often postpone research and development projects, delaying engineering work until business conditions improve. These slowdowns may be temporary, but they can still affect growth. When you step back, a pattern begins to emerge. None of these risks suggest that Tata Technologies is a weak company. They simply remind us that even excellent businesses operate in a world that keeps changing. Markets change, technology changes, competition changes, customer spending changes. Ultimately, everything comes down to one word: execution. Management has ambitious plans to grow faster, expand into AI, deepen customer relationships, and improve profitability. Those goals are encouraging, but investors should remember a timeless principle. Plans create expectations. Execution creates value. And that brings us to the final piece of our story. Every day, millions of investors weigh these opportunities against these risks. Their collective judgment is reflected in one place: the stock chart. So before we conclude this documentary, let's answer one final question. What is the market itself telling us about Tata Technologies today? Over the last 8 chapters, we've understood Tata Technologies as a business, its industry, financials, management, valuation, risks, and latest performance. Now it's time to ask a different question. Does the market agree? Every day, thousands of investors analyze the same company. Some buy, others sell, and together they create one visual record: the stock chart. A chart doesn't predict the future. It simply shows how investor confidence has changed over time. Think of it like an ECG. It doesn't explain the illness. It shows how the heart is behaving. Likewise, a stock chart reflects how the market feels about the business. For Tata Technologies, the story has been interesting. Like many newly listed companies, the stock enjoyed tremendous enthusiasm after its IPO. The Tata name, strong engineering capabilities, and long-term growth story attracted investors, pushing the price sharply higher. But excitement eventually gave way to reality. As expectations settled, the stock corrected and entered a period of consolidation. That isn't necessarily bad. Just as a marathon runner needs recovery before the next sprint, healthy stocks often pause after an early burst of optimism. More importantly, Tata Technologies gradually stopped making significant new lows, suggesting that selling pressure was fading and confidence was beginning to return. Looking closer, another encouraging sign emerges. Each decline has attracted buyers before the previous lows were broken. Rather than sharp speculative swings, the recovery has been orderly and measured. This often indicates gradual accumulation instead of emotional buying. That observation also fits with what we've already seen. Institutional ownership has been steadily increasing. While a chart alone can't reveal who is buying, improving price action alongside rising institutional participation paints a consistent picture of growing confidence. Recent price behavior also suggests improving momentum. Buying interest has strengthened while selling pressure has eased. Popular technical indicators such as RSI, MACD, and moving averages broadly point toward a healthier trend than we saw a few months ago. Importantly, the stock doesn't appear excessively overheated, making the setup more balanced. However, one important test still lies ahead. The stock is approaching a price zone where previous rallies have struggled. Think of a mountaineer nearing the final stretch before the summit. The hardest climb often comes last. If Tata Technologies delivers strong execution and successfully breaks above this resistance with convincing buying support, it would signal that investor confidence is strengthening further. If not, the stock may spend more time consolidating before its next major move. Neither outcome changes the quality of the business. It only affects how quickly the market recognizes that quality. This highlights an important lesson. Fundamentals tell us whether a company is worth owning. Charts tell us whether the market is beginning to agree. One explains the business, the other reflects investor behavior. Together, they provide a more complete picture. At this stage, Tata Technologies appears to be in a healthy position. The business continues to improve, and the market seems to be acknowledging that progress gradually rather than through speculative excitement. The overall message from the chart is simple. The market isn't euphoric, and it isn't fearful. It appears cautiously optimistic. Confidence is improving, momentum is strengthening, and the long-term correction seems to be giving way to a more constructive trend. But as always, the next chapter depends on execution. If management continues delivering stronger growth, healthier margins, and consistent customer wins, the chart is likely to reflect that progress. And that brings us to the final chapter of this documentary. We've analyzed Tata Technologies from every important angle. Now it's time to bring everything together and answer the one question every long-term investor wants to know. Is Tata Technologies truly a stock worth owning for the years ahead? We've reached the end of our journey. Throughout this documentary, we avoided predicting where Tata Technologies stock will be next week or next year. Instead, we focused on a more important question. Is Tata Technologies becoming a stronger business? Because over time, stock prices usually follow business performance. Looking back, Tata Technologies isn't a company that manufactures cars or aircraft. It helps the world's largest manufacturers design, engineer, and digitally develop them. Like an architect behind a landmark building, its work often goes unnoticed, but it's essential. And today, that role is becoming even more valuable. As industries embrace electric vehicles, software-defined products, AI, and smart factories, the demand for advanced engineering continues to grow. Tata Technologies sits at the center of these long-term trends. A business built on strong foundations. The company has built a diversified engineering business supported by long-term customer relationships. Its engineering services business remains the core, while technology solutions is emerging as a second growth engine. These partnerships often last for years, creating high switching costs and giving the company a competitive advantage beyond price. Financially sound, but not perfect. The financial picture remains healthy. The balance sheet is strong. Cash generation is solid. Debt is manageable. Returns on capital remain attractive. However, revenue growth has moderated, and margins are still below earlier highs. These aren't major concerns, but they are important areas to watch. FY26 recovery has begun. FY26 started slowly as global manufacturers remained cautious. But the year ended on a much stronger note. Revenue improved. Large client wins increased. Technology solutions continued to grow. Cash flows remained healthy. Rather than explosive growth, FY26 marked the beginning of a recovery. The next challenge is sustaining that momentum. Management is investing for the future. Management continues investing in artificial intelligence, digital engineering, software-defined vehicles, smart manufacturing, and aerospace. Institutional ownership has also increased, reflecting growing confidence. While institutions are not always right, rising institutional participation alongside improving fundamentals is usually a positive signal. But quality comes at a price. The market already recognizes Tata Technologies as a high-quality business. That's why the stock trades at a premium valuation. A premium valuation rewards quality, but it also raises expectations. Future returns will depend on the company's ability to keep delivering. The risks are real. No business is risk-free. Tata Technologies still depends heavily on the automotive sector. Competition is intense. Engineering talent is expensive. Global slowdowns can delay customer spending. These are execution risks, not signs of a weak business. But investors should continue monitoring them. What is the market saying? The stock chart reflects improving confidence. The long-term correction appears to have stabilized. Medium-term momentum has strengthened. Rather than excitement, the market seems to be responding to improving fundamentals. And confidence built on fundamentals is usually more durable than confidence built on hype. Final thoughts. After examining every aspect of Tata Technologies, one conclusion stands out. This isn't a turnaround story, nor is it a company already operating at its full potential. Instead, it is a fundamentally strong business entering its next phase of growth. It benefits from powerful industry tailwinds, capable management, strong customer relationships, healthy cash flows, and improving institutional confidence. But whether the next chapter becomes exceptional depends on one thing: execution. Can management continue winning global customers? Can margins improve? Can AI and digital engineering become meaningful growth drivers? Can the company diversify further beyond automotive? Those answers will shape its future. And perhaps that's the biggest lesson from this documentary. Successful investing isn't about predicting tomorrow's stock price.
Don't forget to like and subscribe.